The Bank of England has issued a new financial stability report, which they do every quarter or so. And this one is important because it says one overwhelming thing, which is that the risk environment around the UK economy has deteriorated.
3 weeks ago, the central bank published a report that barely made headlines, but should have been front-page news everywhere. Hidden in 57 pages of technical language was a warning so stark that when I read it, I had to go back and read it again to make sure I understood what they were actually saying. They're warning that the financial system is vulnerable to severe stress, that household debt levels are at concerning levels, that commercial property markets are showing signs of distress, and that multiple risks could materialise simultaneously in ways that would cause serious disruption. This isn't some random analyst making predictions. This is the institution responsible for financial stability telling you, in the most careful, legally protected language possible, that they see serious problems coming. And when central banks start publishing warnings like this, it's not because they enjoy being pessimistic, it's because they're genuinely worried. Stay with me, because by the end of this video, you're going to understand exactly what they're seeing that's making them nervous, why the risks they're warning about are more serious than the measured language suggests, and most critically, what you need to do to protect yourself before these warnings turn into reality. Because central banks don't publish these warnings for fun. They publish them when they can see problems building that they might not be able to stop, right? Let me show you how to read what central banks are actually saying, because they don't communicate like normal people. They use very careful, very measured language that's designed to signal concern without causing panic. When a central bank says, the system is vulnerable to severe stress, what they mean is, we can see multiple ways this could go very wrong, and we're not confident we can prevent it. When they say risks could materialise simultaneously, what they mean is multiple things could break at the same time and we'd be overwhelmed. When they say household debt levels warrant close monitoring, what they mean is people are borrowed to the eyeballs, and if anything goes wrong, they're going to default in massive numbers. This is the language of institutional caution. They can't say, we think there's going to be a crash, because that would cause the crash. But they can say, we see vulnerabilities, which is central bank speak for, we're really worried about this. So let me translate the recent warnings into plain English and show you what they're actually concerned about. Warning 1. Household debt vulnerabilities. The official language talks about elevated household debt-to-income ratios and reduced payment buffers for mortgaged households. Translation: people are massively over-leveraged. The average household debt-to-income ratio is at near record levels. Millions of people are spending 40 to 50% of their take-home pay just on mortgage or rent payments. And when interest rates went up, those mortgages that were affordable at 2% became crushing at 5 or 6%. Here's the specific concern. Approximately 2 million households have had to remortgage in the past 2 years, moving from ultra-low rates to much higher rates. Their monthly payments have doubled in many cases. Some have gone from £800 a month to £1,600 a month. That's an extra £9,600 a year. Those households have absorbed that cost by cutting everything else. No savings, no discretionary spending, living paycheck to paycheck. They're one unexpected expense away from being unable to make payments, and there are more coming. Another 1.5 million households will need to remortgage over the next 18 months. They're currently on low fixed rates. When those deals expire, they're facing the same doubling of payments. Can they absorb it? Some can, but many can't. The central bank is warning that if even 10 to 15% of these households start defaulting, missing payments, falling into arrears, that creates stress in the banking system. Banks start taking losses on mortgages. That makes them more cautious about lending. Credit tightens. That hurts the economy, which makes more people lose jobs, which causes more defaults. It's a negative spiral. Warning 2. Commercial property distress. The measured language talks about pressures in commercial real estate and valuations adjusting to new working patterns. Translation: commercial property is in serious trouble, and banks are heavily exposed to it. Office buildings in city centres have lost enormous value because of remote work. A building that was worth £20 million in 2019 might be worth £12 million now. That's a 40% decline. Some buildings have lost even more. This matters because banks lent money against those properties based on the old valuations. If a bank lent £15 million against a building they thought was worth £20 million, they felt safe. Now that building's worth £12 million and the loan is £15 million. The bank is underwater on that loan. Multiply this across the entire commercial property sector, and you've got banks sitting on huge portfolios of loans that are worth less than the properties they're secured against. If property owners start defaulting, and many are because rental income has collapsed along with valuations, banks take direct losses. The central bank is warning that losses in commercial real estate could be significant enough to stress bank capital positions. That's serious. That means banks might not have enough capital buffer to absorb the losses, which could force them to dramatically reduce lending to preserve capital ratios. Warning 3. International vulnerabilities. The careful language mentions elevated global debt levels and potential spillover effects from international developments. Translation: problems anywhere in the global financial system could spread to the UK very quickly, and we're particularly vulnerable because of how interconnected we are. The UK financial system is deeply integrated into global markets. London is a major financial centre. UK banks have large international operations. Lots of foreign capital flows through UK markets. That's great when things are stable. It means lots of business and economic activity. But when things go wrong somewhere else, contagion spreads fast. Problems in US commercial real estate or European banking or Chinese property markets, any of these could create stress that reaches UK institutions within days. The central bank is essentially saying, we can see lots of things globally that look unstable. We're not sure which one might blow up first, but if any of them do, we'll feel it here. And we're not confident we can insulate the UK from global shocks. Now let me show you the specific scenarios they're concerned about, because these aren't vague possibilities. These are concrete breaking points where the system could fracture. Breaking point 1. The mortgage payment shock. Here's the scenario. Over the next 12 to 18 months, 1.5 million more households remortgage onto higher rates. Let's say 15% of them, 225,000 households, genuinely cannot afford the new payments. They start missing payments immediately. Banks initially try to work with borrowers, payment holidays, term extensions, anything to avoid repossession. But after 6 to 12 months of missed payments, they have no choice. They start repossession proceedings. Now you've got 225,000 properties hitting the market as forced sales over a 12 to 18 month period. That's huge supply. Property prices start falling, maybe 10%, maybe 15%. That creates negative equity for recent buyers who bought with small deposits. Someone who bought with a 5% deposit 2 years ago is now underwater. Their property is worth less than their mortgage. They can't sell without taking a loss they can't afford. Meanwhile, falling property prices make banks even more nervous. They tighten lending criteria. Mortgages become harder to get. That reduces demand. Prices fall further. More people end up in negative equity. More defaults follow. This is the housing crash scenario. And it doesn't require anything dramatic. It just requires what's already baked in. Hundreds of thousands of households moving to unaffordable mortgage rates and a meaningful percentage of them being unable to cope. Breaking point 2. The commercial property cascade. Here's how this one unfolds. Commercial property values continue falling. Rental income stays depressed because businesses don't need as much office space anymore. Property owners can't service their loans at current rental levels. Owners start walking away. They hand keys to banks and default. Banks now own buildings they don't want that are worth less than the loans they made. Banks take losses, significant losses across multiple institutions. To preserve capital, banks pull back from all commercial real estate lending. They won't refinance maturing loans. They won't provide new financing. Credit to the sector completely dries up. This creates a fire sale dynamic. Properties need to be sold, but there are no buyers with financing. Prices collapse further. More owners default. More banks take losses. The cycle accelerates. And here's where it gets systemically dangerous. Some banks are heavily concentrated in commercial property lending. If losses are severe enough, it threatens their solvency. That creates fear about which banks are exposed. Interbank lending freezes because banks don't trust each other's balance sheets. Credit across the entire economy seizes up. This is the banking crisis scenario. And it doesn't require fraud or gambling or any of the dramatic stuff from 2008. It just requires too many loans secured against assets that have lost too much value. Breaking point 3. The international contagion. This one starts somewhere else. Could be US regional banks having problems. Could be European banks struggling with exposure to some sector. Could be Chinese property developers defaulting. The specific source doesn't matter. What matters is that when problems start in one major financial centre, they spread. Trading desks in London are connected to New York and Frankfurt and Hong Kong. When selling starts, it hits everywhere. UK banks have international exposures. They've lent to foreign borrowers. They hold foreign assets. They have counterparty relationships with foreign institutions. When those foreign positions come under stress, UK banks feel it. Market stress appears in multiple places simultaneously. Bond yields spike. Credit spreads widen. Equity markets fall. Currency volatility increases. Everything that can indicate stress is indicating stress. In this environment, capital flows to safety. Money exits riskier markets, including the UK. The pound falls. That drives inflation. That keeps interest rates high. That increases mortgage stress and commercial property stress, and all the domestic problems get worse. This is the compound crisis scenario. Multiple things breaking at once, each problem making the others worse. And the central bank's ability to respond is limited because they're fighting fires in multiple places simultaneously with limited tools. So why is the central bank publishing these warnings now? What are they seeing that makes them nervous enough to signal concern publicly? Reason 1. The tools are limited. In previous crises, 2008, central banks had powerful tools they could deploy. They could cut interest rates to near zero. They could do massive bond buying programs. They could flood the system with liquidity. They've already used these tools. Interest rates were at zero. They did enormous bond buying programs. Bank balance sheets are bloated with bonds purchased during previous crises. Now, interest rates are above 4%, but they can't cut much because inflation is still above target. They need to be keeping rates elevated, not cutting them. Their balance sheets are already enormous. Doing more bond buying would look like directly funding deficits with printed money, which damages credibility. So the central bank is essentially telling you, we see problems building, but our ability to respond is limited. We've used most of our ammunition in previous crises. If something bad happens now, we might not be able to stop it like we did before. That's a concerning message. They're saying, we can see the risks and we're not confident we can handle them. Reason 2, multiple risks clustering. It's not just one problem. It's multiple potential problems all happening in a compressed time frame. Mortgage refinancing shock hitting over the next 18 months. Commercial property stress ongoing and potentially worsening. International risks from global debt levels and geopolitical tensions. Inflation still elevated, making policy response difficult. Growth weak, making economic absorption of shocks harder. Any one of these in isolation might be manageable, but all of them clustering together creates the possibility of compound crisis, where multiple things break simultaneously. The central bank is warning about this specifically. Their stress tests look at scenarios where multiple risks materialize together, and in some of those scenarios, the outcomes are severe. They're essentially saying, we've gamed this out. We've run the simulations. In scenarios where several things go wrong at once, the system struggles. We want people to know that because we think the probability of multiple things going wrong simultaneously is higher than normal. Reason 3. Building resilience takes time. When central banks publish warnings like this, part of the goal is giving institutions and individuals time to prepare. Building resilience. whether that's banks raising capital or households building savings or businesses reducing leverage, takes time. By warning now about risks they see potentially materialising over the next 12 to 24 months, they're giving people runway to prepare, reduce debt, build savings, diversify assets. Whatever resilience means for your situation, this is their way of saying, we can see problems building. We might not be able to prevent them, but if you prepare now, you can protect yourself. Don't wait until crisis is obvious to everyone, because by then it's too late.